Hi everyone, today I'm going to represent you an incremental analysis about decisions to eliminate unprofitable business segments. Managers sometimes must consider whether to eliminate a division or segment if it is not profitable or not. The decisions are called keep or drop or continue or discontinue decisions. Managers must consider which costs and benefits would change as the result of the decision. Before deciding to eliminate a product line, one needs to ask the following questions. What costs and revenues would change as the result of the decision? Would the costs and revenues of other product lines be affected by the decision? Are there alternative uses for the resources currently devoted to a product line, opportunity costs? If you want to find out what will happen if you eliminate a particular product, compare two contribution margin income statements, one that assumes that you continue with the product and one that assumes you drop it. Here is an incremental analysis for the Great Soda Corporation. This company is thinking about discontinuing a soft drink line called Fizzy. Let's look what will happen in this situation if the company will continue to produce and sell soft drink line Fizzy. Managers expect to be able to sell just 1,200 cases of Fizzy this year at a price of $10 per case. The cost of making Fizzy is shown here. Total revenue is $12,000. Variable costs are $10,000. Then we have to subtract total sales minus variable costs and we find out the contribution margin. To figure out how much will be the net income, we have to subtract fixed costs from contribution margin. It is $2,000 minus $5,000. In our example, we can see that the net income will be minus $3,000. Continuing to make Fizzy means the Great Soda Corporation loses $3,000. Let's look what will happen if the company will decide to eliminate the product. Sales and variable costs will be zero. However, fixed costs are unavoidable, which means the total fixed cost will be the same whether the Fizzy soft drink line is discontinued or not, $5,000. Again, continuing to make Fizzy means the Great Soda Corporation loses $3,000. However, eliminating Fizzy causes the company to lose $5,000. The total net income will be minus $2,000. The loss is attributable to the Fizzy line $2,000 contribution margin that will be realized if the segment is discontinued. When it comes to profitability, it is a no-win situation. Eliminating Fizzy increases losses by $2,000, so the smart decision for the Great Soda Corporation is to keep making Fizzy. The next example, assume the same facts as above, except now assume the $3,000 of the fixed cost attributed to the Fizzy line can be eliminated if the line is discontinued. In this case, because the company is able to eliminate of its cost by eliminating the division, it can increase its net income by $1,000. This occurs because the $3,000 saving that results from eliminating fixed costs exceed the $2,000 in lost contribution margin by $1,000. As a result, under these circumstances, the company will receive a net income of $1,000. In deciding of the future status of an unprofitable segment, management should consider the effect of eliminating related product lines. In conclusion, incremental analysis can be a powerful tool in evaluating various types of decisions. Also, an important purpose of management accounting is to provide managers with relevant information for their decision making.